Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. They've come to an agreement on the debt ceiling, so we're going to get into what that means exactly and the amounts, because knowing the amounts, you can actually figure out how much this market is going to move. So we're going to get into the details of that in this video. Let's dive in.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
All right, Bob. So the debt ceiling seems to have a tentative agreement, voting on Wednesday. What's interesting, though, is what you found out about the amount that this Treasury is going to have to raise in terms of debt and the effects on the market.
Yeah, so the federal government, and we're not pulling this stuff out of thin air. This actually comes right from the Treasury Department. They announced their borrowing estimates for each quarter going forward. So, which is really interesting to me because we might even be underestimating this, Phil. So originally, the estimates were $600 billion that Janet Yellen is going to need to raise between April 1st and June 30. Okay. Now, obviously, she's been in a debt ceiling lockdown. She hasn't been able to raise that additional dollar amount to refill the Treasury checking account. And so that number actually moved up to 726. And then if you look in the second paragraph on that is the July to September is like another $730 billion of borrowing. So, the question I have is that does she have to raise $1.5 trillion in the next, 4 months? It seems a stretch, but needless to say is that I think the borrowing is going to come in at the higher end of the estimates versus the lower end. And one of the things, and we talked about this before, is that Jerome Powell in 2011, when we had the last big fight, said that once this is over, the United States will create some sort of crisis in Europe and also in the United States to force people out of the stock market into the bond market, because there's just going to be this massive supply of borrowing that somebody needs to pick up. And in 2011, if memory serves me, is that Powell, he wasn't part of it. The Fed governors were actually in an accommodation mode yet. And so this time he's actively selling bonds and securities too. So this is for the first time in a long time, you have both the Fed and the government selling off their bonds, and one is to collect money once they get it off their books. And when I took my economics 101 course, is that supply is going to overwhelm demand. It's going to affect the price, and I think that's going to drive price down and yields skyrocketing on the bond side, and also it's going to suck the oxygen out of the room for every other asset. Look, they've already killed real estate, okay, and they killed the auto lending market, and the only thing really left for them to kill is the stock market. And we did this slide last week. I want to throw it up again if you don't mind, Phil. Is that this is when Yellen raises money, this is what happens to the stock market. Whenever she gets a really low Treasury account and she has to refill it, okay, it drives down the asset values of the stock market. And so you can just see here, just in a short period of time, she did 3 raises and huge dumps. Now, I'm not saying the price is going to stay down, Phil, but it's going to cause dislocation. And I think what we're going to see here is I think we're going to see a lot of volatility. But at first, I think we're going to see a pretty hard and sharp reduction in the price of stock assets until, she satisfies her ravenous desire for cash. And I know we're going to talk tomorrow about why she has to probably overborrow. And I think what it's going to do is it's going to cause tremendous volatility across many assets, but it's going to I think it's going to provide us with an incredible amount of opportunity, Phil, because they're not ready to let this market go to zero yet. This is really, I think, the last gasp that they're going to do, and they're going to try to get themselves through the next election. Because as you know, if this debt deal stands as it is, there's going to be no more debt ceiling talks until the next president is inaugurated. And that's $4 trillion more debt that's going to be pushed into the system. And right now at 3.5% to 5% average borrowing for the government, it's already overwhelming. Interest expenses are already overwhelming the largest categories of our budget.
Right.
And they're going to have to do something about it, or basically this whole thing implodes. So I'll leave that teaser with you guys till tomorrow. And Phil, I want to get your kind of thoughts on the Yellen thing. Let's assume though that this thing passes. We're already hearing whispers that there might be some pushback here and there, which would make the 2011 scenario of a huge drop even more likely.
Correct. I think the vote's on Wednesday, and you're assuming that I guess we're in that 72 hour. Well, right now they're going to be writing up the text of the bill. Supposedly there should be a 72-hour window of review, but they think they can vote on Wednesday. Maybe the review pushes it out to Thursday. That's your first delay. Markets aren't going to like any delays on this right now because we now have a firm X date of June 5th. So if there's any hiccups now, I think you're going to see it taken out on the market, and I think the volatility is going to be pretty high going forward until this thing is approved. To your point on the market dropping, I think that this is the exact same scenario we were in when we went into the first half of 2022, and anybody with a chart can go back and look at that. Wasn't a good time for the markets through June. Basically, we bottomed out, and then we had a bounce. Then we had one more lower low going into fourth quarter of 2022. So I think it's very, very similar to that. The only difference that could be made is if the reverse repo market starts to park less money at the overnight window at the Fed and decides to get into the markets. That would be the only way they can counteract what's going to happen with Yellen as she issues that debt. That debt's going to just hoover up all the liquidity. So the only thing that can combat that now is the reverse repo window. So I think, Bob, what we'll do is we'll show these guys week to week what that reverse repo window is doing and whether or not that's actually happening. Because if the reverse repo isn't cooperating, or if the reverse repo starts to climb because the banks are like, we don't want to be part of this market right now, then the drop is going to be pretty quick because the liquidity is just going to fall off a cliff. I mean, Yellen's really been the only one propping it up. The banks, if you zoom out on the reverse repo balances, they've been trending higher, which means that's less liquidity for the markets. So the banks have been telling us that they're happy to keep parking money at the safety of the Fed window. And if that doesn't change, and I kind of think it won't, because the volatility is going to be coming into this market to the downside. So, why do they risk that where they can just park it, let the market drop, and then they can come back in with a much more profitable level and start putting more money to work at say we take out last year's lows, for example. You're in a much more advantageous spot for all your trillions of dollars of excess liquidity that you're parking at the Fed window. So that's my thought on it. And so I think we probably drop, but I think also too, as we get into tomorrow's video, you guys aren't going to want to miss that one. You're going to see why this is going to be a massive buy opportunity, because the swings in this market are going to be awesome. And if you're able to get in and out of this market and trade like we do in the room, going to be an awesome next 2024 into 2025.
Yeah, and the only thing I want to help people with is the math a little bit. And remember that the Treasury never has a failed auction, okay? So whatever Treasuries aren't being bought up at the auction gets bought up by the banks that are tied to the Treasury. And so let's say they go ahead and they buy one of these bonds that's paying 3.5%. They can just turn right around and take that asset, give it to the Fed, and they can earn 5.5% on it. So they're not going to be taking this excess money and putting it into the stock market. They're going to take that excess, whatever they have to borrow from the to get these Treasury bonds. They're just going to pledge it right back to the Federal Reserve, and they're going to get the reverse repo. The people who pay for that is you and I, because it actually increases the deficit, when the Fed runs negative. So everything always comes back to us getting screwed. But yeah, so remember, they have to, these primary brokers, these primary dealers have to buy every Treasury. If she's going to sell $1.5 trillion in Treasuries, every one of those is going to get bought. It just depends on who's going to be forced to buy it. And then the banks are going to be choking on these treasury bonds, okay? And you know, that's going to crowd out all other borrowing they can do, number one. And number two, they're going to throw whatever excess to the Fed that they can, you know, and probably, you know, drive up the reverse repo that they have, or the Fed's going to have to take them on, and they're going to have to change their QT stance. So it's going to be really interesting to see what this is going to look like. But in the short term, it just sucks all the oxygen out of the room. And I'll tell you what, I will be absolutely shocked, Phil, if we get through the end of July, we have the second quarter earnings, and we have this Treasury refill. If the market isn't substantially lower than it is today, I mean, I would be amazingly impressed with their ability to keep this Ponzi going at that point.
Completely agree. So stay tuned, guys. We're going to show you how that develops as the weeks progress from here. All right, guys. Well, that's going to do it for this podcast. Thanks for watching. Please hit like and subscribe. Smash that notification bell and set it to all if you can. Thanks, Bob. We'll see you guys on the next video. Take care.
Trade Genius.